In this next section, we're going to look at some stock setups, and we're going to begin by doing a dual time frame momentum scan of a portfolio of stocks, which will look at the weekly and daily momentum position for each stock in a portfolio to help us identify potential stock trades. But for any potential dual time frame momentum setup, that's just the first filter to identify a potential trade. Then traders must view the chart and identify the time, price, and pattern position for the potential trade. So we don't make a trade based just on the dual time frame momentum, just as you're taught in the book, is that's a really good filter to identify potential trades. Then we have to look at the individual market to see what position it's in and whether it is a good high probability trade. The menu and setup you see here is a function in Dynamic Trader program called the DT Dual Time Frame Momentum Reversal Scan. As you've learned in the book and seen examples on this CD, is one of the primary filters that we use to identify a potential trade setup is two time frames of momentum in the same direction. In this case, we're going to look at a portfolio of stocks. And what this scanning routine does is scans through an entire portfolio to identify the two time frame momentum position and to provide an alert if the smaller time frame momentum makes a reversal in the direction of the larger time frame. That's exactly what you learned to do in the book by looking at a couple charts and the momentum indicator for the two time frames. This is simply a scan that will scan an entire portfolio each day to identify those setups for you. It just makes things a little quicker and easier. I'm going to start the scan on a portfolio of all the Dow Jones Industrial Average component stocks, the 30 component stocks for the Dow. And it'll just take a minute or two to scan through all those 30 stocks. You can have portfolios of, for instance, I have the NASDAQ 100. I have several portfolios of ETF stocks, and I got a bunch more portfolios here. Some of them I'd scan, some of them I wouldn't. But I think this is particularly handy when you want to look at a large group of stocks and you can't just look at each chart every day. We're getting near the end of the scan, and let me just tell you what it does. It does the same thing I taught you to do just automatically, is that it looks at the weekly momentum position based on the DT oscillator that is the preferred momentum indicator that I use at least. We could do this in different indicators as well if we wanted to set up a scan routine for that. And it looks for the position of bull overbought, bear, or bear oversold. And then it looks at the daily momentum indicator and only gives an alert if that daily indicator makes a reversal that particular day in the direction of the higher time frame weekly. For instance, on the day of this scan, February 8th in 2008, we've got looks like 6 or 7 different stocks that had bullish weekly momentum, and on this day they all made a bullish reversal in the daily momentum. Okay, so it's only going to alert you the day the smaller time frame daily makes a reversal in the direction of the larger time frame weekly. Exactly what you learned in the book. Well, let's take a look at one of these. And I would never recommend that you just blindly buy or sell when one of the dual time frame momentum setup is made. But you go and you look at the chart and you look at the price and the pattern and the time. And then if that's all in alignment as well, if those conditions are all set up for a trade setup, then we'd consider it for a trade in specific trade strategies. So let's look at actually the last one, which is Exxon. It's always interesting, particularly lately, to follow oil company stocks. And let's see if its in a position with its price and time and pattern to consider a long trade, because the weekly momentum is long, it's bullish, and the daily momentum made a bullish reversal on this day that we did the scan, February 8th. As of the week ending February 1st, which was the last complete week before the February 8th dual time frame momentum scan, we see that the weekly momentum is bullish. Looks like it just turned bullish that week. So that's on the weekly data. We know the higher time frame weekly momentum is bullish. Let's go to the daily chart. The daily chart is as of February 8th. That's the last bar in the chart, the day the scan was done. And as we can see, on that day, the daily momentum made a bullish reversal. So we have two time frames of momentum in the same direction, both of them bullish. And it was on that exact day that the daily made a bullish reversal. So we should be either at or very near a time when Exxon goes at least sideways to up. So it's a setup for a bull trade or long trade based on dual time frame momentum. Let's look at the other factors. One is Exxon has come up and down in the position possibly to make a corrective low, kind of the ideal position to consider a long trade. It's at the 62% price retracement, and timing-wise, it's at the 62% time retracement. You can hardly see that figure in here, but that's 62% time retracement. It's also at 100% low-to-low cycle from this momentum low on January 7th through the momentum low, which is also a price low, on January 23rd. 100% forward of that is February 7th. Now I'm showing something else in here. It's called the dynamic time projection, which I had a couple examples in the book on that. And the dynamic time projection does a lot of the time factors that you learned in the book, including time retracements, low to lows, and a number of others, and it gives them a score for each target day, and the higher score days are the ones that have the higher probability of making a trend change. And we can see that right around, it looks like the 5th or the 6th, 7th, and 8th has the highest scores for a possible trend change. So it's really reflecting some of the same information that we have up here on the time retracement and the low-to-low cycle. So we've got dual time frame momentum, we have price, it's right at a retracement level, and we have timing right around February 7th, which is so far the low. And it looks like February 8th, the day of the scan, and when the daily momentum turned bullish, it looks like a little inside day. So this is an ideal setup to consider a long trade and to use some of our entry strategies. So the entry strategy we'll use here is the trailing a 1 bar high in the daily data. So if the market takes out a prior day's high, we'll go long, our stop against the recent low, and then we'll manage the trade as it progresses. So let's first go to the bar high. We're going to set a little alert on the bar high, and then we'll add some data, and we'll follow this trade along and manage it just as you learned in the book. So I'm going to add some data. Well, so the next bar, the market went up, took out the prior day's high. I'm going to clean this chart up a bit, and I'm actually going to I'll just tab these so that we can see all the information a little bit. I just switched it from calendar days to trading days. There we go. And so where's our entry? Was at the high, right above the prior day's high, with our stop 1 tick below the low. I'll even take off that little 62% retracement so we can see these figures right. So we have a stop about $2 away from our entry price. Now, how do we manage the trade? Well, I'm going to use a similar exit strategy as we've used in other examples. And we're going to look for the second daily momentum bearish reversal. And then once the second one is made, if we haven't been stopped out before at least, then we're going to trail the stop in the short-term unit one tick below the lower time frame daily trailing bar low. And then we're only going to look to exit the second unit, the longer term unit, once the higher time frame weekly momentum becomes overbought. So not a specific strategy yet. We want to see on the second unit at least, we want to see what the sort of pattern of market structure is on the way up, up to the point where the higher time frame weekly momentum is either overbought or makes a bearish reversal, if it makes a bearish reversal before it gets overbought. So we have that specific strategy for the short-term unit and the general exit strategy for the long-term unit. So let's add some bars on to the chart and see how we manage the trade as new information is given as new bars are added. Looks like there we've had a bearish reversal, the first one on the daily data. We're looking for the second one. As of the last bar on the chart, we had the second daily bearish reversal. So I'm going to put the alert in here. We're going to be trailing a stop at the 1 bar low. So each day, this doesn't require us to follow the market at all during the day. And of course, most stock traders, well, some of them do very short-term trading and follow it during the day, but a lot of stock traders, they have their regular day job, and so they can only do this, their analysis and put their orders in after market hours. So we'll add some more bars on the chart and see if we get stopped out. Well, we did on the next bar. So we were stopped out of the 1 unit, 1 tick below the 1 bar low, and so we had a gain of about a little over 6 points on the short-term unit. So we were stopped out on February 29th, which just happened to be a Friday. Let's take a look at the weekly data and see if it's overbought yet or not. Let's see, here we have the weekly data as of the week ending February 29th. That's the same day we got stopped out. And only the fast line's in the overbought zone. So with this particular momentum indicator, both lines need to be in the overbought zone before we consider it overbought. So it's still bullish. Typically that would mean we got another week or two of sideways to up in Exxon. So let's go back to the daily data. And what would be our trade management for the second unit? Well, with this much of a gain, let's just move it up to break even or stop in the second unit to break even. There's no real reason to move it up any further just yet. My strategy would be, and it's similar to what I've taught you in the other examples and on some of the strategies in the book, is following the next daily bullish momentum reversal, momentum bullish reversal. Then I'll adjust the stop up to whatever low is made before that bullish reversal. So let's add some more data. And this is another example of how we keep the stop fairly far from the market until we have new conditions that would indicate we should adjust the stop. There we go. As of, no, the last day we still don't have, I'm sorry, I added one too many bars. Let's go back a bar. We was focusing on the momentum position and not on the our stop position there. As of that last bar, we were stopped out. The market kept going straight down, never made that bullish reversal in the momentum. So we're stopped out at break even at the second unit. So even though our higher time frame weekly momentum indicated that this market would be sideways to up, never reached the overbought zone before it came down pretty hard, and we broke even on the second unit and had a fairly nice profit on the first unit within just looks like a couple, 2 to maybe 3 weeks after entry. from entry to exit on the short-term unit. So hopefully you can see again here the value of, even though we might anticipate a larger trend than what actually ends up happening, the value of trading with 2 units and exiting 1 unit at a relatively short-term conditions. In this case, we waited for the second daily momentum bearish reversal before we exited. And that's a strategy we use often on different time frames. And then just only adjusting the stop on the longer term unit when conditions indicate that we should adjust it. In this case, we were looking for another bullish reversal in the daily momentum, but we never got that before the market tanked and came down and took our second unit out. Still ended up with a nice profit on the trade, even though a more significant trend didn't develop. Let's take a look at a few more of the markets from that scan of that same day on February 8th, where we went through this Exxon example in details and the whole trade management from entry through exit. I'm going to bring up, or already brought up, a few of the charts of, we had 6 or 7 markets that day, symbols that day, that had the dual time frame momentum reversal setups. And just take a quick look on how we might judge if that's a market we'd want to trade, or what trading strategy we might want to use just to enter that market. I've just taken the top 3 in alphabetical order from that day. And the first one is AA. And this is the daily chart, and it's as of February 8th. So in other words, as of February 8th, the higher time frame weekly momentum was bullish and it wasn't overbought, and the daily made a bullish reversal. So looks like an ideal setup for a long trade just based on the dual time frame momentum. But as I mentioned earlier, even when you have a setup like that, you always want to bring the chart up and look at the position of this market relative to the price and time, and maybe pattern to see if it's really one we want to trade, or what the trade strategy might be. We don't just blindly buy it or sell it if we have the dual time frame momentum set up. As of February 8th for AA, I think that's Alcoa, Alcoa Aluminum, is the market had a strong up move and then just a little 3-day decline. I don't even need to put any price or time retracements on this chart to see that it definitely has not reached a 50% price retracement, and it has not reached at least a 38.2% time retracement, which are typical for a correction before, or the minimum targets, time and price targets for a correction. So unlike the Exxon example, is this market isn't in a typical place to where a correction is complete. So is it still a good trade? Well, it might be a good trade just based on the dual time frame momentum, but my trading strategy is I definitely wouldn't do an entry strategy based on a trailing 1-bar high in the daily data. I'd do a swing breakout strategy if I was going to consider a trade in this market. In other words, it would have to take out a swing high. Let me get the chart kind of squared up here a bit. Swing high before I'd consider entering this market. So even though the dual time frame momentum says this is a great setup, more than likely this market is going to continue higher immediately, because it wasn't in any good time and price support typical for a correction. I would require it to take out a swing high before entering, and then the swing entry strategy would probably be a good strategy, because if we have this, just think of it logically, that's what you need to do day by day when you look at a market. We have a really strong up move and only 3 days down, nowhere near the 50% retracement. If after just a little minor 3-day correction, this market took off and made a new high, more than likely it's going to continue higher. So I just wanted to show you this one just to think a little logically when you have some conditions in any kind of scan, whether you're using dual time frame momentum or maybe you're using some other sort of momentum or trend following scanning procedure to identify potential trades. Always go and look at the chart, think logically, well, what would be a logical entry strategy, which means what should the market do to indicate it's going to continue higher? So in this case, I'd say it breaking out from this high. Let's look at the next one, XAP. Or excuse me, AXP. AXP, I had a little dyslexia of the symbols there. AXP, which is American Express. And this again is the last bar is on February 8th, the day that scan was done where the dual time frame momentum set up for a long trade. And it looks like it's in a position to where more typically would be in a position to have completed a corrective low in a bull trend. It's come down to the 62% price retracement, and we had 7 bars up, 6 bars down. It's only 1 bar off of the 100% time retracement, which is typically the maximum for a correction. So I haven't got into a lot of details of alternate time or alternate price projections or that sort of thing, but what I want you to learn here is that this market has indeed come into a position that's typical to end a corrective decline and continue a bull trend. So for instance, here our entry strategy could probably be, and probably would be, the trailing 1 bar high in the daily data. That would be our entry strategy under the assumption that more than likely this market would continue higher and take out this swing high. Well, given that it's in the position that's typical for a corrective low, we really don't need to wait for it to take out this swing high before we enter. We can do it much closer to the market. Let's take a look at one more at BAC. So let's see, BAC is Bank of America, and it looks like it's in a similar position that the Alcoa was, in that we have the dual time frame momentum set up, but again, I don't have the time and price relationships on the chart, but it's obvious it hasn't reached 50%, at least a 50% correction in price. It is at the 62% correction in time, 5 bars down after 8 bars up. 5 over 8 is basically 62%. So timing-wise, that's a typical time for a correction, but it hasn't come anywhere near the typical price for a correction. Now, if it's in a strong bull trend, frequently it doesn't make a typical correction. The minimums for a correction, like usually down to about the 50% retracement in price, they have very shallow retracements. But again, given that situation, I would only recommend entering this market if it took out the swing high. If it did that, just like with Alcoa, it would indicate that more than likely, this trend is going to continue. And in fact, it's probably a very strong trend because this minor correction didn't even reach both minimum time and price retracements for a correction. So when you look at a market, kind of think logically, what's the position of the market? Has it reached a typical corrective low in that area in time and in price or pattern? And if not, you'll probably want to use the swing high breakout entry strategy as opposed to the trailing 1 bar entry strategy. As I've taught throughout the book and these examples, is one of my objectives is to teach you how to think and how to make decisions, logical decisions, given the information that the market provides you. So once a market is identified as a potential trade, then you make logical trade decisions based on the momentum, price, time, pattern conditions, as you learned in the book. And again, I want to encourage you to review both all the material in the book, as well as these examples on the CD for how we manage a trade, how we enter the trade, and manage it all the way through the exit. So the more you review and the more you think about what you're learning and how a decision was made, is the better trader you should become.